Advisors Asset Management offers a suite of innovative ETFs to help investors meet their income and capital appreciation goals. Visit aamlive.com/ETF for more information.
Welcome, folks, to Exchange Traded Fridays, powered by ETF.com. I'm Jeff Benjamin, Wealth Management Editor, and I'm joined this week by Senior ETF Analyst Sumeet Roy and Research Lead Kent Tooney. Let's get into this. We got a few cool topics to talk about this week. We'll be kicking things off today with a look at the surprising performance of insurance ETFs in the middle of this active hurricane season. From there, we're going to go and talk about the macro economy in the context of inflation, interest rates, employment, maybe even a little upcoming election chatter, possibly. And we'll be wrapping it up with a look at the popularity of these so-called quick buck ETFs that can invite big risk and big rewards. Maybe not for the meek, maybe, I don't know. If people don't like to sleep at night, that's the kind of thing I would go after. But anyway, guys, insurance ETFs. I wrote about this week. It's kind of an interesting situation. I found it to be a little bit of a riddle or a puzzle. I singled out the two biggest insurance ETFs that we track here at ETF.com. The $766 million iShares U.S. Insurance ETF, ticker IAK, and the $922 million Spider S&P Insurance ETF, ticker KIE. Now, both of those ETFs have strong 3-month and year-to-date performance. The IAK is up 29% so far this year. The Spider S&P Insurance ETF, ticker KIE, is up more than 25% this year. Now, Sumeet, I know you're familiar with these things. It was kind of interesting to me because obviously you think of these insurance ETFs, they hold insurance companies. They both track indexes, but they're kind of market cap weighted indexes of insurance companies. My first blush would be these things are going to be in the tank because the estimates, I just looked at them a little bit ago, the estimates of total property damage is like $200 billion from Hurricane Helene 2 weeks ago and Hurricane Milton, which we're recording this on Thursday, just kind of hit landfall yesterday or last night. So why do these, I mean, what's the bet that makes these things attractive right now?
Yeah, it's interesting, Jeff, watching the moves in these insurance ETFs. You mentioned strong year-to-date performance, but if we look at just this week, IAK, which is one of the two ETFs you talked about, down 3.6% on Monday. So clearly there was a reaction when we first got wind that this hurricane was going to be big, but then it recovered, a half of that or 2/3 of that loss on Tuesday and Wednesday. And in the bigger picture, like you said, this has been a blip on the chart. The fund is up something like 30% year to date versus 22% for SPY. So yeah, I mean, investors seem to have largely shrugged this event off. And I think one reason for that is the anticipated claims from the Hurricane Milton. They were as high as, 100 billion plus just from that hurricane. And now I'm reading below 60 billion. So maybe it's a little bit not as bad as people thought. But I'm also reading that a lot of insurance companies have reduced their exposure to Florida or, if they're in the state, they've improved their terms and conditions, which should reduce any hits that they take. So I don't think this hurricane was unexpected for the insurance companies. They've seen big hurricanes, so they've kind of accounted for that. And if that's the case, then in the bigger picture, things that might be more important for this industry are high interest rates, right? Because ultimately insurance companies, they make money on the float. Warren Buffett obviously likes to talk about how this is kind of like a magic thing where, insurance companies make money before they pay out claims. And interest rates, if you look, they're still pretty high, right? They're close to 5%. We've seen the 30-year, it rallied at 4.3%. So profitability is still very strong for the insurance company. So maybe investors are focusing more on that rather than this hurricane. And hurricane season is probably, going to be winding down over the past month. We don't tend to see as many in November and December, so investors might be looking forward now.
Yeah. Well, and yeah, it has been a relatively mild hurricane season, with the exception of the last 2 weeks, which were just savagely brutal for the Southeast United States. Also, for those listening, the two different numbers that Samit and I gave out, he said 60 billion worth of estimated claims. I said 200 billion worth of estimated property damage. So there's a difference there. I'm not sure how those numbers line up, but we're talking about two different things: property damage and estimated claims. Ken, do you have any take on this? I mean, I that is a great way of explaining that, Samit. The leverage play, I guess, or the interest rate play inside these insurance companies. Because like I said, when I first looked at this yesterday, I was not expecting to see that kind of performance this year, but it's very impressive.
Yes, I can add a little bit there. I mean, to add a little bit to what Samit was saying, I know that insurance companies do invest a significant portion of their premiums in bonds and most of the short-term variety. So, those yields are up, as we all know, because of inflation and just some of the highest short-term rates in decades. But also, I don't know what the exact numbers are. I mean, living on the coast and watching hurricanes, I'm down on the coast of South Carolina. I'm not too far away from Asheville. I know that at least I don't know the percentage of those homeowners did not have flood insurance because they did not think that they would ever need it. And so there's probably not going to be a lot of claims. I mean, if you're talking about $200 billion in damage, I wonder if maybe a large portion of that damage is not covered by insurance companies, and there won't be a lot of claims there, obviously.
Yeah, I guess that's good for insurance companies, but really, really bad for property owners.
Right.
Flood insurance is one of those sneaky little things that you got and you got to get and whatever. I live in North Carolina, as you know, and there's a big debate around here about how much flood insurance you want or if you even want it. But anyway, I guess that's something to keep an eye on. It definitely is a little surprising strong performer this year, even if you take the hurricanes out of the picture. So just a little something for people. Insurance companies seem like a stable bet, and they're obviously performing well. Let's shift over to the macro economy right now, Ken. I know you had some thoughts on that. The CPI numbers are out, or they're fresh. We just had a rate cut not too long ago. Where are things headed right now from your perspective?
Right. So, at least most recently, or since our last podcast, over the last week or so, we've had some hotter than expected, and inflationary economic data coming out. Last week's ADP and the U.S. non-farm payrolls reports. I would say, for lack of better terminology, pulled the rug out from the soft landing narrative and the falling inflation and lower rates expectations. So we're seeing Treasury yields spiking higher, which means prices for rate-sensitive Treasury ETFs like TLT falling. And then, like we also touched on last week a little bit, short-term, especially ultra short-term Treasury ETFs like iShares SGov, and I've been watching JP Morgan's JPST. I call those the have your cake and eat it too funds. For investors expecting, they're expecting higher for longer rate environment. So you've got that ultra short duration, which translates to very little downside price risk, while you're earning 5% yield or more. And by the way, that does outpace the current rate of inflation. So you're getting almost risk-free good yields, and then everyone's expecting high yield money market yields to come down. So it really kind of is a sweet spot to be right now. It's not advice, but that's why we're seeing flows coming in. And by the way, I want to put a plug in for what I'm calling my new favorite tool on ETF.com. It's our new ETF Pulse tool. I was just playing around with it this morning. It just launched yesterday or
Mm-hmm.
earlier in the week. And, I can just put it in fund flows and then fixed income. And I'm seeing top fixed income fund flows. And a couple of the funds I just mentioned, iShares, SGov, over the last month, I plugged into the tool $570 million in inflows, and then JPST, $827 million in inflows. And there's a handful of intermediate term bond funds in there as well. So, one of my favorite ETFs to write about TLT, not in favor right now. We're looking at short term, maybe some intermediate term bond funds are getting the flows, and a better place to be if you want yield and less interest rate sensitivity.
Mm-hmm.
Yeah. And speaking of macro, Kent, it looks like the market is pricing in now only a 25 basis point rate cut at the Fed's next November meeting, though there is even a 20% chance now that the Fed doesn't change rates at all. And it'll be interesting to see whether that, moves up if we get stronger economic data over the next month or so. I think if the Fed doesn't do anything in November, that would definitely be a surprise, but it is certainly a possibility now based on the Fed Watch tool that the CME puts out, a 20% chance of no move currently
Right.
priced
Yeah.
in.
And of course, we need to mention that, today's CPI, or rather Thursday morning CPI, coming in slightly hotter than expected. It was 0.1% month over month expected for the rise in prices for costs and goods and services. But it was 0.2 instead of 0.1. And so then we're still seeing more of that. Okay, we got the higher for longer narrative, and inflation is not vanquished yet. So yeah, definitely 25 basis point expectation for November and December. I think the CME Fed Watch tool is forecasting, I think 78% for both months, over 75% odds of a 25 basis point rate cut.
It certainly seems that like the 10-year is comfortable around 4%, as long as the economy isn't slowing down dramatically or falling into a recession. It feels like that. We've been here for a while. We only tend to go below 4%, it feels, when the economy seems like it's, very sharply slowing down. And obviously after last jobs report, that doesn't seem to be the case, at least right now.
I'd like to talk a little bit about cash in this environment. It's something that became really popular and profitable, money market, CDs, whatever, as the rates were pushed higher over the past couple of years. But even with the rates down slightly from their high, the Fed rate anyway, I mean, it seems like there's still a lot of reason to be sitting in cash accounts right now, if that's your kind of your want. But do you guys think that this is we're at kind of a little bit of an inflection point here, where it's starting to make more sense to maybe move out on the yield curve a little bit, but maybe not too much? I don't know. It kind of strikes me as like you could still make the case, if you're a financial advisor or you're an investor with a lot of cash on the sidelines, to just sit there for a while. But I don't know. Is it now the time, or what?
Yeah, I think so. I mean, I manage money when I'm not writing about ETFs. I like to look at portfolio management, especially for investors that are near retirement or in retirement, with a bucket approach. I mean, any money that an investor needs over the next year, I think this is not advice, just what typically I see, and a lot of other advisors look at it the same way. Is 1 year's worth of income at least in cash. I mean, and you're still earning close to 5%, maybe a little more in some cases, and a high yield money market account. And then so the bucket number two, if you will, maybe 1 to 3 years, you can go a little bit farther on the yield curve, because I mean, if you're holding that money for 1 to 3 years, then yes, short term to intermediate term bonds now, and then of course, depending on the risk tolerance of the investor, maybe higher quality stocks for bucket number three long term. But yeah, I think it still makes sense to have a significant amount of that bucket number one in money market.
But the thing is, you can get such decent yields with really short-term CDs. You don't even have to go out. You don't have to say, "Oh, I'm going to get the most yield," because of this inverted yield curve. You don't have to sit there and say, "Well, I don't want to risk sitting in a CD for a year because I don't know what rates are going to do, or I don't know how long these rates are going to be good, or where else I should be going." I mean, the highest yields in CDs right now are the shortest terms. So it seems
Yeah,
like a no-brainer to just sit in those things.
sure.
Yeah. Yeah. It's been a no-brainer, but of course, the biggest risk with those is the reinvestment risk. So if interest rates drop dramatically, then you're kind of gonna have to live with those lower yields, right? Whereas if you buy longer duration type of fixed income securities, you can hold on to those long rates for longer, even if rates fall all of a sudden. So that's kind of, the other
Yeah,
side of it.
I guess it also depends. Everybody's unique. What the reason is for your cash in that position. If this is cash because you want to have a certain amount of emergency money, you're just going to take what yield you get because liquidity is more important than the yield. But if it's just waiting for an opportunity or something like that, to me, if rates just start to drop like a rock, that's going to be great for, or probably good for the equity market. So take that opportunity. I don't know. It's
Yeah,
it's
true. And another thing to consider, Jeff, is all of a sudden, long duration bonds, things like TLT, we are seeing that inverse correlation again with the equity markets. When
hmm
recession risks flare up, we're seeing TLT rally. So you might want that duration in your portfolio, kind of acting as a hedge. So you're not going to get that with the ultra short and things like that. Totally different animal.
all right. Sumit, you want to talk about or introduce us to these quick buck ETFs that I know you're I'm not gonna say you're a fan of, but I know you're curious about them, and which tells me that you probably know a lot about them.
Yeah, absolutely. I mean, we've been talking about yields, and I want to talk about this Bloomberg article from earlier this week, which talks about how retail investors are diving into derivative-based ETFs, essentially in search of massive yields, right? We've written and talked a lot about these funds at ETF.com, but this piece by Bernadette Walker does a great job getting to the bottom of why these ETFs have been so popular. She
hmm
mentions that derivatives-based ETFs have seen their assets grow sixfold to $300 billion over the past 5 years, which is just incredible. Now, when she mentions derivatives-based strategy, she's essentially talking about two types of ETFs, which are covered call ETFs and leveraged ETFs. And primarily the first category is what she focuses on, covered call ETF. These are things like JEPI, which is that ETF we talked about pretty much every other day last year. Anyway, so JEPI kind of kick-started this covered call craze, and it's still a huge fund. It has $36 billion in assets, remains the most popular ETF in the category by far. But as the article points out, JEPI's success has led to issuers releasing a whole bunch of other covered call ETFs, many of which focus on just one stock, like TSLY. It's a Tesla covered call ETF, almost $800 million in assets under management. The problem is some of these more exotic covered call ETFs are extremely risky. TSLY, for example, advertises a 115% distribution rate, which sounds amazing. But then you look at the total return and it's down something like 15% over the past year because the price of the ETF has gone down more than the distribution. So the question I think the article brings up, and it's a great one, is whether these ETFs are democratizing sophisticated investment strategies or whether they're simply taking advantage of retail investors who might not know any better. So that's the question. And, what do you guys think?
I think it's the latter. I really do think that these are trading vehicles, and I hate to do this because I'm always against these rules that put gates around certain investments and don't allow everybody to invest in everything. But there should be some kind of at least a test you have to take before you can invest in these things. I mean, I just don't think a lot of people understand the leverage and how it works and how it cuts both ways and how, a lot of these things, these single stock ETFs, they're not designed to be held for multiple days because they're levered. Obviously, if you want to buy Tesla stock, you can go buy Tesla stock. But if you're buying an ETF with just Tesla in it, it's because it's got leverage in there, or it's inverse. It's giving you short exposure. It's basically doing sophisticated trading for you. They're not designed to be held for the long term because you can see the way that the impact would be as you're holding something that resets every day. We got some that reset less frequently, but they're still trading vehicles. I just did a story. I don't know. I guess it was today. And it was it was from Schwab, some research from Schwab that was showing what different investors, generational investors, are doing, and it showed that millennials have the largest allocation, at least in the 2,200 people that they surveyed, but they have the largest allocation in general to fixed income. They have the most appetite for fixed income right now, and the guy that did the report, David Bott, said over there at Schwab Asset Management, he deduced, and it makes sense to me. He said, because we don't know what else is in their portfolios. You tend to think millennials, they're younger to be in that age group, so they would have to have a longer time period, investment horizon. Why are they in so much fixed income? Well, the theory is that because they've got all this other stuff that's more active and more risky, and maybe they got crypto, they got alternatives, and they got a lot of these leverage things. So that's maybe their ballast. Like I said, I think that these things, I'm happy they're out there. I think it's great if you know what the heck you're doing, but I think it's, for less sophisticated investors, you can be playing with fire.
Yeah, absolutely. Ken, would you ever recommend any of these to your clients?
No, I do not. Like Jeff said, I mean, they're really daily trading instruments. Some used for hedging and some for a quick buck. They've aptly been given that nickname. But yeah, just a quick example. I mean, we've written on other nicely named ETFs. Direxion China ETFs leveraged 3 times the yen, YINN, and yang. Yin yang. After China had that 50 basis point rate cut, everyone's excited about, hey, China stimulus. It's the economy's been slow. Now it's going to kick into hyperdrive. But around the middle of September is when that happened, or a couple of weeks ago. But that yen, 3 times leveraged China ETF, jumped like over 100% over a handful of days. And then, now it dropped 30%, shortly after that. So yeah, you can make a quick buck, but you can also make a quick loss. So, I mean, easy come, easy go is what I say. But yeah, I would not recommend these, but if used properly and the risk is understood, then it might be right for some investors.
I understand the leveraged ETFs, the 2X, the 3X. Those are pretty straightforward if you're, a short-term trader, or you just think something's going to go up, you want to magnify your returns. It's just like margin, right? That makes sense. I'm scratching my head more over the whole single stock covered call ETFs. I just don't understand TSLY, something like that. Why would you write covered calls on Tesla systematically like that, right? If you want to participate in the upside of Tesla, you can buy Tesla stock, or you can even buy TSLL, which is the 2X Tesla ETF. But by writing covered calls on it, you're capping your upside, yet you're still exposed to almost all the downside of the stock at the same time. So that's kind of a head scratcher for me, these single stock.
I guess if they're not giving you any downside protection, then the trade-off for the covered call, the cap on the upside, is they're giving you some kind of an income stream, right? So
they are, but
so it seems like a way to add a dividend yield to a stock that is not giving you a dividend yield.
I understand that, but I think the only time that's gonna really pay off is if the stock is flat, right?
Yeah.
Then then that might
Yeah.
work out. But if the stock's
It
going
is funny.
down,
I mean, you're buying a growth stock, but you want dividends. So
yeah.
it is a funny, I guess there's a market for everything, and we'll see if there's how much of a market there is for this. But that's a good point. Putting a covered call strategy on top of known as a pretty hot growth stock is a little
It's
bit.
another have your cake and eat it too kind of idea. But that, yeah, my cynical and short response to that is that, we cover ETF launches and we cover ETF closures, and we see some of these trends come out that either catch on or they don't. So it's kind of like another type of throw something out there to see what the demand is. So the issuers are probably, they're not trying to hurt anyone, but they're like, hey, if there's a demand for it, then we'll get some inflows. But then if not, then they'll just close the fund down, and we've seen that happening a lot over the last couple of years.
Yeah, great way to put it, Kent. Obviously, if there's demand for it, issuers are going to sell it. And this article brings up a great point about how a lot of these ETFs are being marketed on social media, like through YouTube influencers and things like that. And I think that's a smart move, obviously, on the part of issuers. And it kind of goes hand in hand with the rise of retail investors that we've seen since the pandemic. It's not just about meme stocks and things like that. A lot of that retail money is going into these kind of exotic ETFs that we've seen launched over the past year. Anyway, I think that's a good place to wrap it up. Thanks for tuning into Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or want to share your thoughts, join the conversation with us on Twitter at ETFcom. That's ETFcom. Catch you next week.